This strategy is simple, but the logic behind it is very strong. It helps you track the trend shift, confirm the pullback, and then enter only when price starts moving with real momentum again. So I'm on TradingView, and the concept of magical numbers may sound unusual, but the real value here is not the name behind them. Now let's set everything up properly, go to Indicators, and search for Moving Average Ribbon. This built-in TradingView tool is useful because it lets you add multiple moving averages even if you are on the free version. Open the settings, you can do that from here, and remove one of the moving averages because we only need 3 lines here. Then set the moving average type to EMA. For the first EMA, set the length to 15. For the second EMA, set the length to 34. For the third EMA, set the length to 111. Also, change this EMA color to green from here. Then, go to the Style tab and make the lines easier to see on the chart by making them thicker. The longer EMA should be green, and the other 2 shorter EMAs should stay clearly visible as your faster trigger lines. Now let's understand what each EMA is doing. The 111 EMA, which is the green line, is the main trend filter in this setup. This is the line that tells us whether the market may be shifting from bullish to bearish or from bearish to bullish. Then the 15 EMA and the 34 EMA help us with the structure of the new move and the pullback behavior. So the green line gives the bigger picture, and the other 2 EMAs help with confirmation and entry timing. Let's start with how to read the green line. When price is above the green 111 EMA, the market is more likely in an uptrend. When price is below the green 111 EMA, the market is more likely in a downtrend. So the first thing we watch for is price crossing from one side of the green line to the other side. But this is very important. We do not trade the first cross alone. That would be too risky. The market can move below the green line, then back above it, then below it again, especially in a choppy area. So the first cross is only the early warning that trend may be changing. It is not the actual entry. Now let's go through an example in detail to understand the process better. Suppose price was above the green line and then closes below it. That is the first signal that the uptrend may be ending and a downtrend may be starting. But we still wait. The next thing we want is for both of the faster EMAs, the 15 and the 34, to also move below the green 111 EMA. This shows that the shorter term structure is now aligning with the bearish idea, but even here we still do not enter yet. We want one more thing, and that is the pullback. If a real downtrend is starting, then after the initial break, price should pull back, but that pullback should stay controlled. In this setup, we want the pullback to reach at least the area between the 15 and 34 EMAs, or at most move back to the green 111 EMA. Price should not close above the green EMA. If it does, the setup becomes weaker and the trend shift is no longer clean. Now, once that pullback happens, we wait for a candle that closes below the 34 EMA. That is our signal that the pullback may be ending and bearish momentum may be returning. But even here, you do not need to rush. If the candle is weak, small, or indecisive, you can wait for a better bearish candle with a stronger body. That is actually better because this strategy is about catching the start of a new move, not jumping into weak momentum. So the sell trade setup is simple when you break it down. First, price crosses below the green 111 EMA. Second, the 15 and 34 EMA also move below the green line. Third, price pulls back into the EMA area or toward the green line without closing above it. Fourth, you wait for a strong candle to close below the 34 EMA. That is where the sell entry becomes valid. In practice, you could enter on the next candle, place your stop loss above the green EMA, and target a 1-to-2 risk to reward ratio. It's easy and simple, and you can take your time confirming really if the trend is shifting. There is no need to rush. Now let's go to the buy trade setup.
Do you feel like everyone around you benefits from artificial intelligence, but you have no idea where to start? Don't wait any longer. Start today. Our free trading bot is simple to use, powered by artificial intelligence, and can earn you up to 1% profit every single day. Over 500 members have already joined. Click the link below now to get free access. This is your chance to harness the power of AI and take a step toward a financial boost.
This works the same way, just flipped. First, price crosses above the green 111 EMA. That is the first clue that the downtrend may be ending and an uptrend may be starting. But again, we do not buy the first break. Next, we want the 15 EMA and 34 EMA to also move above the green 111 EMA. That tells us the shorter-term structure is now aligning with the bullish idea, but still, we wait for the pullback. In a buy setup, we want price to pull back into the area between the 15 and 34 EMAs, or at most touch the green 111 EMA. It should not close below the green EMA. If it does, the setup becomes weaker and the bullish reversal is no longer clean. Once that pullback is in place, we wait for a candle to close above the 34 EMA. That is our signal that the pullback may be ending and bullish momentum may be returning. And just like in the sell setup, if that candle is weak or small, you can wait for a stronger one. You want a candle with a solid body that shows real intent, not just a weak push. So the buying setup is also very straightforward. First, price crosses above the green 111 EMA. Second, the 15 and 34 EMAs move above the green line too. Third, price pulls back into the EMA area or toward the green line without closing below it. Fourth, a strong candle closes above the 34 EMA. That is where the buy entry becomes valid. In practice, you could enter on the next candle, place your stop loss below the green EMA, and target a 1-to-2 risk to reward ratio. What makes this strategy useful is that it forces patience. It does not let you buy every break above the green line or sell every break below it. It makes you wait for structure, then for pullback, then for renewed momentum. That extra sequence is exactly what filters a lot of bad entries. For example, there will be times when price breaks below the green line and it looks like a new downtrend is starting. But then the pullback closes back above the green line. In that case, the bearish setup is no longer clean and you stay out. That is a false signal avoided. The same thing can happen on the bullish side. Price may break above the green line, but if the pullback closes back below it, then the bullish case weakens and you avoid the trade. That is why this method is not just helping you enter, it is helping you avoid bad entries too. That is it for this one. If you have any questions, leave them in the comments and I will answer as soon as possible. And if you have not subscribed yet, subscribe to the channel and turn on the bell icon so you do not miss the next video. See you in the next one, and good luck with your trading.